Hi, welcome to my video. This video is FA1 Chapter 5, Property, Plant and Equipment. So this chapter is very important to you because in this chapter you can understand the concept of depreciation. You can know how to record when the company has disposed their asset and also the concept of revaluation. So let's start. What is depreciation? Company purchase fixed asset for business use and expected to enjoy the economic benefit of using the fixed asset for certain period. Therefore, company need to recognize the cost of using the fixed asset when the revenue are generated. The concept is called depreciation. Depreciation is the application of matching concept. So maybe by this wording, it's very hard for you to understand what is depreciation. So we better use a diagram to explain this. So let's show a diagram. Okay, imagine the company has buy a motor vehicle, right? Let's say this motor vehicle, the value is 50,000. So tell me, what is the accounting entry when we purchase the motor vehicle? We know that we will debit motor vehicle 50,000 and then we credit to either cash or bank 50,000 to recognize the purchase of the motor vehicles. And we know motor vehicles is classified under asset. So let's give an assumption. This motor vehicle we are expected to use for 5 years. So tell me, what is the value of these motor vehicles over this 5 years? The value will increase or the value will decrease. I repeat, this motor vehicle value is 50,000 and we expect it can be used for 5 years. So tell me, over this 5 years period, the value of the motor vehicles will increase or decrease after you use? I guess the answer is very obvious, right? The answer is this one. The value of the asset will decrease over the period. Why the asset value will become lesser after you use? For example, second-hand car is definitely cheaper than the first-hand car, right? And also when you use the asset will have some problem. Let's say the motor vehicles need to repair more regularly, so those factors will cause the asset value will decrease over the period. That's why we need to use a concept called depreciation. Under the concept of depreciation, we will use a formula to determine what is the cost of using the asset. We will use a formula to determine what is the cost of using the asset, and the cost of using the asset we will recognize as expenses. We will recognize as expenses for the cost of using the asset. So after you recognize the depreciation of your asset, the asset value will decrease over the year. So this concept is called depreciation. So let's go back to the textbook. So before we go into detail of the depreciation calculation, we have to understand some key terms when we're doing the accounting of property, plant and equipment. First one, depreciation. An accounting adjustment to recognize the cost of using the fixed asset, and this is an expenses of the company. What is accumulated depreciation? The aggregate depreciation since the date of asset purchase. It means that year 1 you add to year 2, you add to year 3. So we call accumulate. It means that we add all the depreciation together. Next one, cost. Monetary value of asset when purchased. It means that the money that you paid for getting the fixed asset. Next one, net book value. Net book value is the net value of the asset. So what is the formula of net book value? We use cost minus accumulated depreciation. Next one, useful life. What is useful life? the estimated times or period that a company can enjoy from the use of asset. To take note, the estimated time, the useful life of the asset must be reasonable. For example, for computer, you can set 3 to 5 years, but you cannot say 10 years because 10 years may be too unrealistic for a laptop or computer. For example, handphone, you can set 2 years, 3 years, 5 years useful life. But if you set for like 20 years, which is not so reasonable. So the setting of the useful life must be reasonable. Next one, scrap value, or another name called residual value. So this is the remaining value of the asset after the end of the useful life. So we back to the example just now. Let's say we assume that the motor vehicle can be used for 5 years, right? So after 5 years, do you think that this motor vehicle still have a value for resale even you have finished the useful life? I think the answer is yes. This is the remaining value after you have finished the using of the asset. So we call this concept as scrap value or residual value. Next, addition. When we say addition, refer to the purchase. Disposal refer to sale of fixed asset. Written off. Written off means you remove the fixed asset of the company. Reason is due to you cannot use or you cannot sell. For example, let's say you have a laptop and your laptop already spoiled. So if you go to the second-hand computer shop, you want to sell, they don't want. Can you still using? You cannot using because already spoiled. So you have to write it off. Next, sale proceed. Sale proceed refer to the selling price of the disposed asset. Trade-in. Use the selling price of the old asset to offset again the cost of new asset. A typical example for trade-in is motor vehicle. Let's say you have a motor vehicles, you want to change a new one. Normally you will sell your second-hand car to the dealer, to the car dealer. So the price of the old asset can be used for offset against the cost of new asset. Of course, you will not fully offset, right? But you will partially offset the cost of the new asset. So we call trade-in. Next one, pro rata. What is pro rata? Based on the numbers of months that an asset is used to calculate the depreciation. Normally, when we calculate the depreciation, we have to base on pro rata basis. For example, let's say this is a calendar year. Let's say 1, 3, 6, 9, 12. If you purchase the asset on purchase motor vehicle, for example, at September, your depreciation shall only account the 3 months period. Okay, when you calculate the depreciation, you shall only calculate 3 months only. Why? Because you only use for 3 months. The rest, can you still charging the depreciation? No, you are not suggest or you are not advised to charge the depreciation for the period that you are not using the asset. So this concept we call pro rata. We charge the depreciation only when we use the asset. So next, when we calculate the depreciation, it can be presented by a percentage or a useful life. So this formula showing you that how to convert from a percentage to a useful life. Example, you use 1 divided by the useful life times 100%, you can get a percentage. For example, if the asset can use for 4 years, it means that the depreciation rate is 25%. If the useful life is 5 years, then 20%. 10 years, 10%. So this is an example for you. So for depreciation, we have two methods to use. The first method is called straight line method. The second method is called reducing balance method. So for the ease of calculation or presentation, I will use the whiteboard to show my answer. So this will be exactly the same as your textbook. So don't worry. Alright, so let's look at the classroom exercise 5.1. In this 5.1 exercise, we are discussing the use of straight line method for your depreciation. So under the straight line method, how to compute your depreciation? We use cost minus scrap value and then multiply with the depreciation rate. If you are given a useful life, then we use cost minus scrap value and then divided by the useful life. So let's do this exercise to practice the depreciation under straight line method. The cost of a motor vehicles is 100,000 with a scrap value of 8,000. It is expected that it can be used for 4 years. Please compute the depreciation, accumulated depreciation, and net book value of the motor vehicles if the company use straight line method to account depreciation. So this exercise is very clear. They want us to compute the depreciation, accumulated depreciation, and net book value by using what method? Straight line method. So first, we record the cost of the asset. The cost of the asset is 100,000. Depreciation, how we charge the depreciation? Depreciation, if for this question, the use is using useful life of 4 years, so we use this method. So we use cost 100,000 minus scrap value, which is 8,000, and then divided by 4. We use the cost minus scrap value 8,000 divided by useful life, which is 4. So answer, $23,000. So the depreciation for year 1 is 23,000. What is the accumulated depreciation? 23,000, because this is the first year. The total depreciation of this asset is 23,000. Net book value, we use 100 minus 23 to get 77,000. Let's check the answer. 100 minus 23,000, so it's 77,000. So we have completed the first year. So second year the cost will be the same, 100,000. The cost of the asset will not change over the period, because this is the amount that you paid for the acquire or for the purchase of the asset. This is a historical cost, and this amount will not be changed. Next, depreciation. So depreciation is still the same. We use 100,000 minus 8,000 and divided by 4. We get 23,000. So what is the accumulated depreciation? It means that the total depreciation of this asset over the period. The total accumulated depreciation at year 2 will be 23,000 plus 23,000. So we get 46,000. How to get these two amounts? We use last year accumulated plus this year depreciation. We use last year accumulated depreciation plus this year depreciation. So we get total accumulated depreciation for year 2. And your net book value will become 100 minus 46,000 to get 54,000. Year 3 and year 4, the depreciation will be the same, 100,000, because the cost of the asset will not change over the period. depreciation, if you're using straight line method, you can see that the depreciation is the same over the useful life of the asset. Why? Because the factors or the input in the formula is fixed. You see, the cost, we will not change the cost, we will not change the scrap value. So since the input in the formula will not change over the use of the asset, so your depreciation amount will be the same over the period. For accumulated depreciation, year 3 accumulated depreciation, we use last year accumulated plus this year depreciation, which is 46,000 plus 23,000, total 69,000, and your net book value 100,000 minus 69,000 to get 31,000. And for year 4 accumulated depreciation, we use last year accumulated depreciation plus this year depreciation, which is 69 plus 23, so we get 92. Net book value 100,000 minus the current year accumulated depreciation 92, so you get 8,000. So that's all for the depreciation of straight line method. So for straight line method, there is a features. You can see that the depreciation will be the same in the 4 years period. Alright, every year will be the same, 23,000. Why? Because the formula in the input does not change. The formula or the input in the formula will not change over the period. Cost will be the cost, scrap value will be the scrap value. These two factors will not change during the period. So this is your depreciation under straight line method. So next, we would like to discuss the depreciation under reducing balance method or residual value method. So this is classroom exercise 5.2. So for reducing balance method or residual value method depreciation, how we compute the depreciation? We use cost minus accumulated depreciation and multiplied by with the depreciation rate or divided by the useful life. So let's have a comparison between straight line methods and reducing balance method. For depreciation under straight line method, we use cost minus scrap value, but reducing balance method, we use cost minus accumulated depreciation. So these are the difference between straight line method and reducing balance method. So you have to remember this formula, because if you miss out the input of the formula, you will get a totally different answer. So let's see this one. Classroom exercise 5.2, the cost of the motor vehicle is 100,000, same as the previous question, 8,000 for the scrap value, 4 years useful life also the same. But this question, they want us to compute the depreciation, accumulated depreciation and net book value under the reducing balance method. So let's start. Let's see the difference between reducing balance method and straight line method. So the cost of the asset is 100,000. Depreciation, we use 100,000, which is your cost, and accumulated depreciation. For the year 1 purchase asset, you will not have previous depreciation, so your accumulated depreciation will be 0. Why 0? Because this is first year purchase asset. You will not have any previous accumulated depreciation. And then divided by 4, so you get 25,000, and your accumulated depreciation become 25,000 because this is first year. Net book value 100,000 minus 25,000, you get 75,000. So this is your first year depreciation, accumulated depreciation, as well as net book value. And we know that the cost of the asset will not change over the period, so we can write down the 100,000. Next, second year depreciation. Second year depreciation, we use cost minus the previous year accumulated depreciation, which is 25,000. This amount from here, and then divided by 4. So let's use calculator. 700 minus 25,000, we get 75,000 divided by 4. We get 18,750. And your accumulated depreciation, we use 25,000 plus 18,750. We get 43,750. How to get this amount? From here and here. Last year accumulated depreciation plus this year depreciation will be your total accumulated depreciation up to year 2. Net book value, we use 100 minus 43,750. So we get wrong amount. 100,000 minus 43750, 56250, 56250. And next, for year 3, the depreciation will be 100,000 minus 43750, and then divided by 4. How do I get 43750? From here. So we use 100 minus 43750 to get 56250, and then divided by 4. We round out the figure, 14063. 14063. When during the accounting, you can round out the amount. No need to show up to decimal point. And your accumulated depreciation will be 43,750 plus 14063. So we get 57813. Sorry, 57813. So how we get 57813? We from last year accumulated depreciation plus this year depreciation. And your net book value, 100,000 minus 57813. 42187. And for last year, year 4, we use 100,000 minus 57813 divided by 4. How to get 57813? We get from last year accumulated depreciation. $10547. And for accumulated depreciation up to the end of year 4, 57813 plus 10547. $68360. and then your net book value. So how we get the, we use last year accumulated depreciation plus this year depreciation. Net book value, we use 100 minus 68360. $31640. So that's all for asset or depreciation under reducing balance method. And you can see that the depreciation is being reduced over the period, right? From 25,000 to 18 to 14 to 10. The depreciation amount is getting lesser, right? Reducing in the value, right? That's why we say this is reducing balance method. So you can compare both methods. So we can say that if your depreciation under straight line method, your depreciation amount will be the same over the 4 years period. If your depreciation is calculated by using reducing balance method, your depreciation amounts will be reduced. That's why we say reducing balance method. And you may ask a question, sir, how about this 8,000? Why this 8,000 is not using in our formula? Let's look at the formula again. Depreciation is calculated by using cost minus accumulated depreciation and multiplied with depreciation rate or divided with useful life. So did you see any scrap value in your formula? No, right? It means that the scrap value under reducing balance method is irrelevant information. Irrelevant information when you compute the depreciation. So don't use the scrap value when you compute the depreciation under reducing balance method. And what is the accounting treatment when you record depreciation? The accounting entry for depreciation, we debit the depreciation and we credit to accumulated depreciation. So depreciation is an expenses in income statement. Accumulated depreciation is asset under SOFP, and this is non-current assets. So the next example, I'm going to show you how to record the depreciation in a ledger. So I will see you in the next video. Thanks for watching.